Welcome to this explainer. Today we're unpacking a truly fascinating situation. We are looking at Blackstone's unbelievable first quarter 2026 performance and the intense, almost polarized debate happening right now over what the company is actually worth. We're talking about the world's absolute largest alternative asset manager here. They just posted numbers that completely defied a really turbulent macroeconomic environment, but Wall Street is totally split on how to price them. To kick things off, we really have to stop and ask ourselves, how exactly do you put a fair price tag on a firm operating at this kind of staggering scale? It's not like valuing a traditional company that just makes and sells products. We are talking about a firm managing a massive, deeply complex web of global real estate, private equity, credit, and infrastructure. Valuing a machine like this properly means we have to look way past the surface-level numbers and really understand the gears turning underneath. Okay, let's jump right into part one, the $1.3 trillion behemoth. As of the first quarter of 2026, Blackstone is sitting on a mind-boggling $1.3 trillion in assets under management. To put that into perspective, they stand completely alone at the top of the mountain as the world's largest alternative asset manager. But here's what's even more incredible, how incredibly lean they are while running all of this. According to their recent workforce data, Blackstone operates with just under 4,900 total employees. Think about that math for a second. On average, every single employee at this firm is effectively overseeing over $250 million in assets. It's a textbook example of an incredibly high-leverage business model. And it gets even more interesting. Look at what CEO Stephen Schwartzman highlighted in their recent release. Almost $70 billion in capital inflows. And remember, this is despite a really choppy economic environment. While a lot of the market was sweating over geopolitical tensions and interest rate anxiety, investors happily handed Blackstone another $70 billion in a single quarter. It just proves the sheer resilience of their all-weather model. It's designed to protect capital when things get rough, while still allowing them to aggressively invest where they see the best opportunities, like their massive push right now into data centers and AI technology. Moving right along to Section 2, decoding those Q1 2026 earnings. So how does that massive scale translate into actual profits? Well, this right here is the heart of their profit engine, distributable earnings. This is a crucial metric to watch for asset managers because it represents the actual hard cash profits available to be handed back to the shareholders. And wow, they saw a massive 25% year-over-year jump. They went from $1.41 billion in Q1 of 2025 straight up to $1.76 billion in Q1 of 2026. This huge boost was driven by a 23% increase in fee-related earnings, plus over $500 million in realization revenues. In short, their ability to harvest profits is just firing on all cylinders right now. For those of you hunting for income, this is where it gets really good. That stellar performance powered a robust 4.9% dividend yield, which paid out as a $1.16 quarterly dividend per share. In a world where everyone is desperately looking for yield that can outpace inflation, getting nearly 5% from a blue-chip financial giant like this is a massive magnet for investor capital. Which brings us to Section 3, the valuation tug-of-war. Here is the trillion-dollar question. At its recent price of around $119.55, are you actually getting a bargain today, or are you just paying a massive premium for future promises? Over the past year, total shareholder return has actually been down a bit, which has created this really fascinating situation where value investors are circling. Everyone is trying to figure out if this is a rare golden entry point or just a classic value trap. And here is the core conflict playing out in the market right now. The most popular bullish narrative sees a fair value of $143.45, which would mean the stock is roughly 16.7% undervalued. The bulls will point straight to Blackstone's insane $177 billion in dry powder. That's uninvested capital just sitting there, ready to be deployed into distressed assets, coupled with a 35% year-over-year expansion in their private credit business. But if you use a strict discounted cash flow or DCF model, it paints a totally different picture. By projecting out future cash flows and strictly discounting them back to today, this conservative math pegs fair value significantly lower at just $111.72. Through that specific lens, the stock is actually overvalued today. So it really comes down to which set of assumptions you trust more, the explosive potential of their dry powder or the hard conservative math of their current cash flows. Let's put this into perspective in Section 4, Blackstone versus Apollo. If you compare Blackstone head-to-head with its biggest rival, Apollo Global Management, the valuation gap becomes glaringly obvious. Apollo is trading at a much more affordable valuation. They have a forward price-to-earnings ratio of 14.2 times compared to Blackstone's hefty premium of 19.5 times. And if we look at the price-to-sales ratio, which measures the value relative to total revenue, Apollo sits at just 2.4 times, while Blackstone commands a whopping 7.3 times multiple. By traditional valuation metrics, Apollo looks like a way better bargain. So we have to ask, why is the market willing to pay such a massive premium for Blackstone?
Well, that difference really comes down to a fundamental divergence in their strategies. Blackstone leans heavily into real estate. It makes up roughly a third of their total assets. And as we all know, real estate is incredibly sensitive to interest rates, which totally explains some of the recent stock turbulence they've experienced. Apollo, on the other hand, uses a very unique integrated model. They run a robust retirement services business through their subsidiary, Athene. This funnels a steady, massive stream of capital from everyday retirement funds directly to them, which fueled an incredible 44% jump in Apollo's fee-earning assets last year. Compare that to Blackstone's 11% rise. Basically, Apollo is growing its fee base much faster through retirement services, while Blackstone relies on defending its crown through massive, unmatched scale in real estate and credit.
Finally, let's wrap things up with Section 5, risks and our final verdict. Look, even if you are totally on board with that bullish $143 valuation, we have to stay objective and weigh the macro risks. Higher interest rates could easily continue to pressure the values of Blackstone's massive global real estate holdings. Plus, if market volatility spikes, it could delay Blackstone from deploying that $177 billion in dry powder. It could also slow down their ability to sell off assets and collect those lucrative realization fees we talked about earlier. Because their revenues are tied to when they can profitably exit an investment, there's always going to be an element of unpredictability here. So I'm going to leave you with this final thought to chew on as we close out this explainer. Does the world's absolute largest alternative asset manager, with its undeniable $1.3 trillion scale and all-weather resilience, truly deserve that premium price tag? Or do the macroeconomic risks, particularly in real estate, point you toward cheaper, faster-growing competitors like Apollo? It is a classic market tug-of-war, paying up for the absolute best-in-class leader or seeking out a better fundamental bargain. Thanks so much for joining me today to unpack this incredibly fascinating company.